Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
So our first guest today on the show is Michael Beresford. He's the director at Open Corp. G'day, Michael. How are you? And thanks for joining us.
G'day, Tim. I'm well. Good to be with you.
Nice one, mate. Now, it's that time of the year again where people start planning for the year ahead. So I just wanted to get your view on it. How do you see the market going in 2018?
Yeah, look, it's a great question, obviously one that we get asked about a lot. I think probably the best way to answer that question is to help everyone understand that there's not one property market in Australia. Obviously, there are the key capital city markets, which is how Open Corp prefer to invest, purely because you've got the most amount of people and the most amount of jobs, the least amount of property compared to other areas across the country. But really, I guess we've seen very strong markets throughout 2017 and even prior in Sydney and Melbourne especially. So I think 2018 really provides a big opportunity for some of the other interstate markets, especially Brisbane and to a lesser extent Perth, in terms of where investment opportunities at affordable levels in capital cities that have a lot of appeal to residents, owner-occupiers and renters, from a lifestyle perspective that provide really good opportunities to get into the market based on where those interstate markets are at.
Now, I noticed that I see that you guys are investors yourself that started out also with just one property, and today you only recommend investments that meet your own property portfolio criteria. What is it that you look for?
Yeah, that's right. So we're continuing to add properties to our own portfolios as a group of directors and employees at Open Corp, and we just help our clients do exactly the same. So, I've got clients that have got property in the same street as my own. The process that we apply to be able to add properties to our portfolio, we call it the MAP process. And basically it's a process of elimination. It starts with M is for market, so which capital city market or markets make the best sense at any point in time. Obviously, over the years, that those locations will change. A stands for area. So within the capital city markets that make the best sense right now, which are the growth corridors, hubs, suburbs, locations, etc., that best fit our criteria within those capital cities? And then once we get the area locked down, what's the specific property that gives us best growth potential and the best amount of incoming cash flow, so that we can hold these properties with very little money out of our own pocket, if any at all. And what that does is it allows us to build a portfolio of several properties over time, because buying one property in your portfolio and doing only that is not going to get most people the financial goals that they're after. So it's really a process of how we're not trying to pick the absolute winner every single time. What we are looking for is opportunities that are in existing suburbs. We're really playing the supply and demand game here. The least amount of available supply, the most amount of demand based on where existing infrastructure and future infrastructure and government spend are going into, as well as where there is affordability and demand for residential housing. From there, the science really gets down to, well, how do we identify exactly the right kind of property that will maximise our rental income, maximise our tax benefits, so that most Australians can apply our investment strategy, for as little as $50 a week, if that, week to week, in terms of cash contribution out of their pocket, to hold a property worth $500 to $600K.
So getting a successful portfolio together, it sounds like there's a couple of moving parts that all need to come together, and the trick is to balance them all in one place.
Yeah, look, I guess the hardest part of this process is actually the time it takes to identify these areas and do the research. The process itself, is not only written about in the books that we've written, but others that have, been successful investors in the past. So the process itself is not rocket science. The two hardest parts in applying our process are, number one, being unemotional about what you invest in. That's a real challenge that a lot of investors, especially first-time investors, have. They feel they need to love what they invest in. It needs to be the application of a process that works, not something that you love. And the second part is just the time-consuming nature to actually go through and understand which capital city markets, areas and properties fit that map criteria that we have. Our research and acquisitions guys estimate it's a smidgen under 200 hours, all going well, that it takes to be able to do the due diligence against that criteria to pick the locations that we're investing in.
I mean, it doesn't end there, does it? Because you also provide add-on education services as well, mentoring, market analysis and financial expertise. Tell us a little bit about that.
It's all tied in together, Tim. So, as I said before, buying one property is not going to help people achieve the financial goals that they're after. The most common goal that I've heard over my 15 years of talking to people about property is that it'd be great for them to be able to replace their income in about 15 years, give or take. So without having to go to work to earn the money, obviously. So I guess, if you're thinking that most people want somewhere between, 80 to 120 grand in terms of that passive income, then it's going to take a portfolio of property to do that. As I said before, where most people buy a property in the same suburb they live in, that's not a recipe for success. And why most people don't actually get to the point where they're able to build a substantial portfolio. The ATO say that there's about 15,000 Australians that have a portfolio of 6 investment properties or more. We're very proud that 9 of those 15,000 odd are in our office. And so that's really, the cornerstone of what it takes to be successful is understanding why you are applying the strategy that you are. So that's really where, the education side of things comes in. It's not plausible to think that you can be an expert overnight in this stuff. We've been doing this for over 20 years. But I guess we take our clients on the journey of what our strategy is, why it works, what's important, and the property investment fundamentals, as well as making sure that the strategy that we're talking to them about is likely to help them achieve the financial goals that they're after. Because our process is not get rich quick, it's get very rich slow, but it does take time to produce results. And I guess that's a long-term approach to property investment is prudent. So we start with that education basis so they understand why they're investing in the kind of properties they are, and then really we take leadership and ownership of that whole process. So acquisitions, packaging, we facilitate the purchase. We can help them with finance if need be. Anyone else they might need to deal with through the process, accountants, financial planners, etc., we can introduce them to. And then really most importantly, the part that investors are excited about is getting a tenant at the other end. We help with that. We've got property management in-house, so we know what's important to investors before then really embarking on a portfolio management journey. And that's really, us at Open Corp being the eyes and the ears for our clients with their portfolio, helping them understand and action what they need to do to achieve those financial goals that they set out to achieve. So, a couple of times every year we're feeding them information on what the market rents are doing, what the comparable sales are, reviewing their situation. Do they have equity to repeat the process and add to their portfolio or not? What do we need to do to help them manage cash flow a bit better, or whatever it might be? But it's really a long-term partnership where we take a lot of pride in helping people get to the end result that they're after.
Thanks, Michael. Now, if anyone wants to learn more about Open Corp and anything that we've chatted about today, how can they find you?
Yeah, great. So a couple of options. Jump online to www.opencorp.com.au. There'll be some all of our book publications on there. There'll be access to about 280 educational videos on all things property investing. They're a bit of fun as well. Or you can give us a call on 1300 Open Corp. And we're happy to provide an opportunity to sit down and look at anyone's individual scenario and see if there's a fit between what we do and what they're looking for at no cost and no obligation as well. So hopefully that's useful for all the listeners out there.
Certainly is. Thank you very much, Michael. Nice to have you on the show.
Good to talk to you, Tim.
Nice
Thanks.
one. Cheers, mate. So our next guest joining us today is Drew Evans. He's the director at Caifu Property. G'day, Drew. How are you? And thanks for joining us.
Good. Thanks for having me, Tim. Appreciate it, mate.
Very good. Now, we know that some of our highest web traffic occurs during December and January through the year as people start planning for the year ahead. So I just want to pick your brain a little bit, Drew, about 2018. How do you see the market moving in the new year?
Sure thing, Tim. Yeah, mate. What I've noticed over the last, decade of working in the industry is I think that 2018 is going to be very interesting in the fact that we can't normally or necessarily rely on the market forces to generate equity that we need to continue to grow our portfolio. So we've all experienced, or hopefully experienced, the good fruits that the Sydney and the Melbourne markets have bared. But I see 2018 where we're not going to see the price surges like we've recently seen. And I also believe that the cycles are going to be a little bit lower and a little bit slower. So I think 2018 is going to be a year where you need to find out additional ways other than just buying property and hoping that it goes up in value.
Now, the big thing around that is I guess, equity and developing equity or growing equity in the portfolio. What's the best way for people to manufacture their own equity as their portfolios develop?
Yeah, sure thing, Tim. Well, I mean, I've been pretty fortunate myself to generate quite a decent portfolio, and obviously been helping clients along the way to do so. So ordinarily we could do things like, renovations or subdivisions or, strata title type developments. But what we found, or what I found personally, is I just don't have the time to physically coordinate and orchestrate those types of property investments. So we've really been focusing on the custom build strategy. Now, whether that's something as small as just building a house with inherent equity, or doing something like a duplex or a dual income property, all the way through to using managed investments by developing anything from sort of 3, 4, 5 to 6 townhouses at a time is how we really see the best results. And that's the way that I see the best future for 2018 to create those same results.
Now, you guys have got a couple of tactics that you use to generate equity, and the first one of which is instant equity. Tell us a little bit about that.
The old saying goes, you make your money when you go into a deal. So whenever I'm looking at opportunities, or I help my clients look at opportunities, is we really need to see what other properties are actually selling for in the area. Not what's listed on realestate.com or on Domain, but what is actually done, dusted, settled, and sold in the area. So instant equity for me is, if I'm going to be doing it, developing a site or building a duplex, is how am I making my money going into a deal? What are comparable properties actually selling for or have sold for, to make sure that upon completion of any type of building, I am going to have that instant equity. So with that philosophy in mind, it's really important to look at comparable sales, not what's listed on a real estate website.
And another one is manufactured momentum. Tell us a little bit about that, Drew.
Yeah, manufactured momentum, or we also call it mechanical momentum. We tend to help our clients invest in areas where there's big multi-billion-dollar companies that use their business forces to actually drive up the value of an area. So I recently helped a client invest in an area where they purchased some land for $339,000, and that was in stage 3 of a master plan. If we fast forward, 7 to 8 months, that exact same size parcel of land in the exact same stage is now worth $409,000. So that mechanical momentum has effectively generated in excess of $70,000, irrespective of what the rest of the market is doing. In fact, that market was only performing at 2.85% throughout that time frame, but yet our clients have seen in excess of $70,000 of equity uplift thanks to that mechanical momentum.
And a third tactic that you use, and it works quite well, doesn't it, is market maturity?
Yeah, so market maturity is what most investors, I guess, rely on, in the fact that they invest in an area hoping that it will go up over time. Now, of course, traditionally speaking, if you invest the right way, property should go up over time. But I guess we use instant equity to generate our equity a whole lot quicker. We use mechanical momentum to capitalize on business forces, and then we still invest in areas that we believe are going to at least double or triple in the long term. So it's really important when you are manufacturing your own equity that you look at those 3 tactics. You don't just rely on buying a property and hoping that it goes up in value. So
it's almost like you put the whole lot together, you plan it from the beginning, you drive it through, you make sure that you're getting the full and proper result from it.
Yeah, that's right. So, effectively, we teach our clients how to double the value of their salary within 18 to 36 months so that you can continue to grow your portfolio and keep growing forward.
Thanks for joining us today, Drew. If anybody wants to learn more about anything we've chatted about today, how can they find you?
Sure thing, no worries. Well, you can go directly to our website, which is www.automaticequity.com.au, or you can contact us on 1300 881 422.
Thanks, Drew. Thanks for your time today.
All right. Thanks, Tim.
Cheers, mate.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.